Have you ever wondered why there is so much skepticism surrounding Americans' finances? It seems like every time we turn around there's another headline warning us about the precarious state of our economic affairs. But is this skepticism completely justified? Let's take a moment to unpack this. The skepticism around Americans' finances is rooted in a variety of factors. For starters, we live in a world of economic ebbs and flows, where booms and busts are part of the natural cycle. These fluctuations can make it seem like we're constantly on the brink of financial disaster, even when that's not necessarily the case. Then there's inflation, the silent thief that slowly erodes our purchasing power. As prices rise, our dollars don't stretch as far, leading to concerns about affordability and financial stability. And speaking of stability, the job market plays a significant role in shaping our financial outlook. With automation and outsourcing threatening certain industries, it's not surprising that many are skeptical about the future of their finances. But let's not forget the cost of living. From skyrocketing housing prices to the rising cost of healthcare and education, it seems like everything is more expensive these days. And with wages not always keeping pace, it's easy to see why skepticism abounds. Yet amidst all these concerns, there's an intriguing development that seems to defy this skepticism: the robust earnings of American banks. Yes, you heard that right. Despite all the economic uncertainties and financial challenges we've just discussed, American banks have been posting impressive earnings. This raises an interesting question. Could these bank earnings be a sign that the financial situation in America is not as dire as the skeptics would have us believe? So what if this skepticism isn't entirely valid? What if the narrative of financial doom and gloom doesn't tell the whole story? What if there's more to the picture than meets the eye? Let's explore the recent American bank earnings and see what they reveal. Buckle up, because we're about to delve into a fascinating world of numbers, trends, and insights that may just turn your perception of American finances on its head. First, we must understand what bank earnings are and why they matter. Bank earnings, in the simplest of terms, are the profits that banks make. They're the financial gains recorded after all expenses, including taxes and operational costs, have been deducted from the bank's total revenue. This is the bottom line that tells us how well a bank is doing. But why does this matter? Well, bank earnings are an essential health indicator of the financial sector. If banks are profitable, they can lend more, leading to increased business activity and economic growth. On the other hand, if banks are struggling, this could spell trouble for the economy as a whole. Let's break this down further. Bank earnings are primarily composed of two main categories: net interest income and non-interest income. Net interest income is the difference between the interest a bank earns from its lending activities and the interest it pays to its depositors. If a bank loans out money at a higher interest rate than it pays to its depositors, it makes a profit. On the other hand, non-interest income is generated through fees and services. This includes everything from ATM charges to fees for financial advice. In an ideal world, a bank wants to increase both its net interest income and its non-interest income. There's another key term we should understand: loan loss provisions. These are funds that banks set aside to cover potential losses from loans that may not be repaid. Higher loan loss provisions can eat into bank earnings, but they also reflect a bank's prudence and preparedness for any financial downturn. In essence, bank earnings are a crucial barometer of the financial sector's health and the broader economy's vitality. They offer insight into consumer confidence, business activities, and economic trends. Now, with a better understanding of bank earnings, we can delve into the recent trends and their implications. Against all odds and skepticism, American bank earnings have been on an impressive run. In the face of doubt, American banks have shown remarkable resilience. The recent earnings reports have painted a picture that defies the skepticism that was prevalent. Let's delve into the heart of this financial phenomenon to understand it better. One of the key drivers of this trend has been the economic recovery. With businesses reopening and jobs being created, there's been a noticeable uptick in economic activity. This recovery has been a boon for banks, with increased deposits, loans, and overall financial transactions contributing to their bottom line. Another contributing factor has been lower loan loss provisions. During the height of the pandemic, many banks had to set aside large sums of money to cover potential loan losses. However, as the economic situation improved and borrowers started repaying their loans, banks have been able to lower these provisions, instantly boosting their profits. And let's not forget the role of the American consumer. Increased consumer spending has been a critical factor in driving bank earnings. As people started feeling more confident about the economy, they began spending more using credit cards, taking out loans, and making investments. All these activities have a direct impact on a bank's revenue. But it's not just about the big national banks. Smaller regional and community banks have also shared in this success. These banks, often overlooked in the broader narrative, have played a crucial role in supporting local economies and have seen their earnings increase as a result. However, it's not all sunshine and rainbows. Banks have faced their fair share of challenges, from low interest rates to regulatory concerns. But despite these hurdles, their ability to adapt and thrive is commendable. These earnings are not just numbers, they tell a compelling story of resilience and defiance. They are a testament to the American banking industry's ability to weather storms and come out stronger on the other side. They serve as a reminder that even in the face of adversity, American banks have the capacity not just to survive, but to thrive. You might be wondering, what do these high bank earnings mean for the average American? It's a valid question, and the answer might surprise you. High bank earnings have several implications, many of which can trickle down to impact the average American in positive ways. Let's delve into some of these impacts. Firstly, high bank earnings can serve as an indicator of a robust economy. They suggest that businesses are thriving, people are borrowing and investing, and the financial sector is on solid footing. This can instill a sense of confidence in the economy among consumers and investors alike. And as we all know, confidence in the economy can lead to increased spending, further investment, and a general sense of financial security. Secondly, when banks are doing well, they are more likely to lend. This means that if you're looking to buy a house, start a business, or take out a student loan, you might find it easier to secure a loan. And what's more, you might even be able to secure that loan at a more favorable interest rate. That's because high bank earnings often mean banks are competing for your business, which can drive down interest rates. Lastly, high bank earnings can also lead to better interest rates for savers. When banks are flush with cash, they have more money to lend out, and they need to attract depositors to provide that cash. That can lead to higher interest rates on savings accounts and certificates of deposit, benefiting those who prefer to save rather than spend. So, while it's easy to think of high bank earnings as something that only benefits the Wall Street elite, the reality is much more nuanced. The health of our banks is intricately tied to the health of our economy, and a healthy economy benefits us all, whether we're borrowing, investing, or simply saving for a rainy day. High bank earnings can signal a healthy, resilient economy which benefits all of us. Scene script. Despite this positive news, skeptics remain. So, what are their concerns? It's a valid question. After all, every silver lining has a cloud, and in the world of finance, those clouds can sometimes bring a storm. So let's address some of the concerns that skeptics have raised. First and foremost is the specter of inflation. With costs rising across the board, from groceries to gas, there's a fear that this could eat into bank profits. It's a valid concern. However, it's also important to remember that banks are not immune to inflation. They can adjust interest rates and fees to help offset these costs. Plus, they have the resources to weather the storm better than most. Another concern is economic uncertainty. With global events like the ongoing pandemic and geopolitical tensions, it's hard to predict what the future holds. But remember, banks are seasoned veterans in navigating choppy economic waters. They've weathered recessions, depressions, and financial crises. They have the experience and the expertise to adapt to changing circumstances. Then there's the potential for a bubble. With bank earnings soaring, some worry that this could be a sign of an overinflated market about to burst. But let's not forget that high earnings don't automatically equate to a bubble. They can also be a sign of a healthy, thriving industry. Moreover, banks have stringent measures in place to mitigate risk and prevent a repeat of past mistakes. Yes, these concerns are valid, but they don't necessarily negate the positive trends we're seeing in bank earnings. In fact, they highlight the resilience and adaptability of our financial institutions. They remind us that banks are not just profit-making machines, but vital cogs in the economic wheel, helping to keep it turning even in the face of adversity. The financial world is complex and ever-changing, but these high bank earnings offer a glimmer of optimism. So let's not let skepticism cloud our vision of the potential for growth and prosperity. So, what's the takeaway from all this? Well, let's take a moment to reflect on what we've discussed so far. We've delved into the skepticism surrounding American finances and the strength of our economy. We've dissected bank earnings, understanding their importance not only as a measure of a bank's success, but also as a barometer for the health of the economy as a whole. We've seen how American banks have been posting impressive earnings despite the doubts and uncertainties. But these aren't just numbers on a balance sheet. These earnings represent the resilience and the robustness of the American economy. They reflect the dynamism of our markets, the strength of our industries, and the perseverance of our people. These earnings have real implications for the average American. When banks are doing well, it means they have more resources to lend to businesses and individuals. It means they can invest in communities, create jobs, and support economic growth. It's a testament to the resilience of our economy, even in the face of skepticism and doubt. But here's the key point. These aren't just one-off results. The strong earnings we're seeing are part of a broader trend. They're a sign that our economy is on solid footing, that it's capable of withstanding challenges and bouncing back from adversity. That's why it's important to stay informed, to keep up with the latest developments, and to understand what's happening in our economy. Knowledge is power, and the more we understand about our financial system, the better equipped we are to navigate it. So let's defy the skeptics. Let's embrace the evidence of our economy's strength and resilience. Let's celebrate the success of our banks, not as an end in itself, but as a sign of the vitality and dynamism of our economy. Despite the skepticism, American finances are showing resilience, and that, dear listeners, is a reason to remain hopeful about the future.